97% of retail traders lose money, and you have probably heard that before. What you usually don't hear is why. Most explanations stay on the surface. Bad strategy, poor timing, lack of discipline, and my personal favorite, you can't beat the big guys. But those are just part of the great reason, not the root cause. After nearly 10 years in the market and working with over hundreds of retail traders, I have come to a different conclusion. Although exceptions exist, serious traders don't lose because they are careless or incapable. They lose because they start at a structural disadvantage and no one explains that to them before they put their savings on the line. In this video, I'm going to break down those structural reasons. The one that sits beneath strategy, beneath mindset, beneath all the tactical advice you will find online. And by the end, I will show you how the Lumeric framework is designed to address each of them directly. So the key question here is simple. Why do traders lose money? Because once you can answer that clearly, you stop guessing and start building on a foundation most traders never have. Before we get into it, I'm Wang, lead instructor at Lumeric Trading. We build structured, no-hype futures education for independent traders. Everything I teach on this channel is grounded in the curriculum inside the Lumeric Trading program and our official course book, Day Trading Futures, a Practitioner's Guide for Independent Traders. Link to both are in the description below. Let me start with a concept from our official course book. Trading is a craft. Like surgery, like engineering, like flying a commercial airplane. You would not hand a scalpel to someone who watched a few hours of surgical videos and called themselves a surgeon. You would not put someone in a cockpit just because they read a few Reddit posts about flying either. But that is exactly what happens in the retail trading space. Someone watches a handful of videos, read a few articles, open a brokerage account, and starts trying to extract money from markets dominated by institutions. Firms with years of infrastructure, teams of analysts, and technology that individual traders simply do not have. This is not a strategy problem, this is a structural disadvantage. So let's break down what that actually means. I'm going to walk you through 6 specific reasons from chapter 10 of our coursebook that explain why most traders struggle. And more importantly, why these structural issues are not just technical mistakes. The first and most fundamental reasons why traders lose money is that they operate without a specific trading plan. A trading plan is not a vague philosophy. It's not I buy when prices goes down and sell when the prices goes up. A real trading plan defines which market you trade, what setup criteria must be present before you take a trade, where your entry is, where your stop is, where your profit target is, and where your maximum daily loss is. Without that, every decision becomes discretionary in the moment. And in the moment decisions in life markets are almost always emotional decisions. When you're watching a position move against you, your brain does not process risk rationally. It defaults to fear, and that fear causes traders to move stops, hold losers for too long, and exit winners too early. A trading plan removes that discretion from the moment. It moves the decision making to when you are calm, objective, and not watching your account balance change in real time. Chapter 12 of the coursebook is entirely devoted to building a complete trading plan, an actual step-by-step framework for creating one that is specific to your market, your risk tolerance, and your strategy. The second structural reason is poor risk management, and in specific, lack of position sizing framework and no real stop-loss discipline. Here's a simple question most retail traders cannot answer before they place a trade. How much in dollars am I risking on this trade? Not how many contracts, not where the stop looks right on the chart, how much money is at risk if the trade failed. In trading, that number is not guesswork. It comes from 3 inputs. Number 1, the tick value of the contract. Number 2, the distance from entry to stop, measured in ticks. And lastly, the account size. If you do not calculate that, you're not really managing risk. It's just wishful thinking. And that's really not a strategy. Most retail traders I know default to round numbers. 1 contract, 2 contracts, a stop placed where it feels right. But without a defined relationship between position size and risk, every trade becomes inconsistent. One loss might be manageable. The next one might be irreversible. That is how accounts slowly erode and eventually break. This ties directly into reward-risk structure. Over a series of trades, profitability depends on one simple principle. Your average winners must be larger than your average losers. But most traders do the opposite. They take profits early, lock in small gains, and when a trade moves against them, they hesitate. They widen the stop, they hold on, hoping it will come back. So gains remain small, losses expand. Even if the win rate, the percentage of successful trades is over 50%, the math catches up. This is not a discipline issue in isolation. This is a structural gap. Without a defined position sizing model and a clear reward to risk framework, even a decent strategy will not have long-lasting results. The third structural reason is over-leveraging. It sits right next to poor risk management, but it deserves its own focus because it's one of the fastest ways to destroy an account. Futures are leveraged instruments by design. Take the NQ as an example. One standard contract gives you exposure far beyond what most retail traders should be handling relative to their account size. And yet, broker will allow you to trade it with relatively small margin deposit. But this is the key point. Just because you can trade that size does not mean you should. Over-leveraging means taking on more exposure than your account can actually realistically handle during normal market movement. And normal matters here. The market does not need to crash to hurt you. A routine move, something that happens every day, can be enough to take a large percentage out of an over-leveraged account. If you have a $10,000 account and you're trading a full NQ contract, a relatively small move against you can result in a significant loss on a single trade. That is not bad luck, that is a structural risk, and it compounds because once your account gets hit hard, your ability to recover becomes limited. You're forced into a position where you either reduce your position size dramatically or take on even more risk trying to make it back. That is how accounts spiral out of control. Let me be real with you. Futures trading involves real risk, and leverage amplifies that risk. If you're not prepared for drawdown, this market will expose that quickly. This is not something to avoid. It is something to control. Position sizing, leverage management, and drawdown control are not advanced topics. They are foundational because in most cases, accounts are not lost because of one bad trade. They are lost because of how size was managed across a series of trades. This is a structural problem, not a tactical one. The fourth structural reason is one almost no one talks about. Retail traders do not understand who they are trading against or how price actually moved. Futures market are not driven by retail activity alone. They're dominated by 5 groups: investors, dealers and brokers, market maker, hedgers, and speculators. And within that structure, the participants that move price at scale are institutional funds, market makers, and large commercial hedgers. So when retail traders look at a chart and spot a pattern from some online videos, they're not seeing the cost. They are seeing the result. They are reacting to price that has already been shaped by larger participants with more capital, more information, and a clearer objective. That is a built-in disadvantage. Because if you do not understand what is driving the move, you're always one step behind it. This is why market dynamics matters. You need to understand who is active, what they are trying to do, and how their order flow translate into price levels you see on the chart. Without that, technical patterns become disconnected from reality. They might work sometimes, but there is no underlying framework to explain when they should or should not work. This is exactly why market dynamics is the first pillar in the Lumeric framework. Everything else builds on it. The full framework is structured around 4 pillars: market dynamics, trade analysis, risk management, trading psychology. Each one addresses a different layer of structural disadvantage. And until you understand those layers, you're not just trading the market, you're reacting to it without context. The fifth structural reason is overtrading. Taking too many trades, trading out of boredom, trading to recover losses, trading simply because the market is open. Every trade carries a cost. There is the spread, there are commissions, and there is the mental cost of making decisions under pressure. Overtrading multiplies those costs without increasing your edge. But more importantly, overtrading is usually not the real problem. It is just a symptom. It points to something deeper, a lack of clear criteria. When a trader does not have a defined standard for what qualifies as a valid setup, everything starts to look like an opportunity. The market is always moving, and if your criteria is too vague, you can justify almost any trade. That is where the problem begins, because now you're not selecting trades, you're reacting to movement, and reaction is not the same as execution. The solution is not just more discipline, it is structure, a trading plan with specific defined entry criteria. These are conditions that must be met before a trade is even considered. That removes ambiguity, it narrows your focus, and it turns trading from constant activity into selective execution. Because in the environment, doing less but Doing it with precision is what actually improves results. The sixth structural reason is the failure to treat trading psychology as a core part of performance. Most traders know psychology matters, but they treat it as something separate. I just need more discipline. I need to control my emotions better. That framing is incomplete. The emotional cycle of a trader is not random. It is highly predictable, and it shows up in patterns. After a winning streak, confidence builds, then turns into overconfidence. Position size increases. Risk expands. After a losing streak, the opposite happens. Doubt creeps in. Good setups get skipped. Execution becomes hesitant. And then there's revenge trade. A loss triggers frustration. The urge to make it back quickly takes over. The next trade is forced, oversized, and poorly planned, and it usually leads to another loss. These are not isolated mistakes. They are recurring patterns. Traders who understand this cycle can recognize where they are during a live session. They can step back before the pattern escalates. Traders who do not understand it are driven by it without realizing what is happening. That is the difference. Psychology is not a soft skill. It is a structural component of execution. And the solution is not just awareness. It is building guardrails into your process, define position sizing rules, daily loss limits, clear criteria for when to stop trading. These are not restrictions, they are protections from your own worst decisions under pressure. This is why trading psychology is one of the 4 pillars in the Lumeric framework. Because without it, even strong technical understanding can break down when it matters most. I built Lumeric trading because I got tired of watching intelligent people lose money, not because they are lazy or they lack talent, but because they lack structure. The 4 pillars, market dynamics, trade analysis, risk management, and trading psychology, map directly to the 6 structural reasons I just described. They are not arbitrary categories. They are the 4 areas where retail traders are most disadvantaged, and the 4 areas where structured education makes the biggest difference. If you want the full breakdown of why independent traders fail, I put together a free guide called 7 Reasons Why Independent Traders Fail and the lessons to take away from them. Comment trading below and we will send it to you. It goes deeper on several of the structural issues I have covered here today, and it's free. If you're watching this and recognizing yourself in one or more of those 6 areas, that is actually a good sign. Most traders who lose money never identify the real reason. They blame luck, timing, or they assume the market is somehow stacked against them. The reality is more precise. The market is not rigged, it is structured. And that structure cripples traders who enter without the right foundation. So the solution is not another strategy, it is a better framework. That is what this channel is built around. Each video targets a specific layer of that structural disadvantage and breaks it down in a way you can actually apply. If you're serious about trading futures, as an independent trader, there's a path forward, but it starts with building the right base. This is not for everyone. It requires capital you can afford to lose, a willingness to focus on process before result, and the discipline to measure and review your performance honestly. If you're prepared to approach it that way, the Lumeric framework is designed to give you the structure most traders never get. If this gave you a clear sense of what this channel is about, go ahead and like the video and subscribe. We post structured futures education every week, and each video builds on the last. If you're going to follow this, follow in sequence. Comment trading below and we'll send you the 7 Reasons Why Independent Traders Fail guide. It is free and is tied directly back to the 4 pillars we covered today. If you're ready to go beyond YouTube, the Lumeric trading program walks through the full framework in depth. Market dynamics, trade analysis, risk management, and trading psychology. All structured and taught step by step. You'll find the link in the description. And for those who want more of a personal touch and direct guidance, I offer limited one-to-one coaching sessions where we take a focused, in-depth look at your trading, your process, your decision, and where things need to improve. You can book that directly through the website or in the link below. Our official course book, Day Trading Futures, A Practitioner's Guide for Independent Traders, is also available on Amazon. It is the written version of everything we teach here. Even the preface alone will give you the right perspective before you go further. If you'd like to learn more about futures trading, click this video. You're one video closer to being a professional futures trader. Thanks for watching, and we'll see you in the next one.